Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm sitting down with Kelli Marti. Kelli is the Senior Managing Director and Senior Portfolio Manager at Churchill Asset Management by Nuveen. She's going to be talking to us about what is happening in the US private credit market. Kelli, it's great to see you again. Welcome back to Livewire.
It's great to be here. Thanks for having me.
How would you describe the current health of the US private credit market, particularly against expectations?
So if we look at the trend in default rates, and by default rate I would mean a payment default on a loan, it's actually trended down over time. Fourth quarter 2024 default rates would have been just a tick over 1%. And we've seen that drop to only 90 basis points in the first quarter and only 70 basis points in the second quarter. And again, those stats are for the US private credit landscape as a whole, not the individual asset managers. And it's going to vary by asset manager, but very benign default rate environment. So that's good to see.
Kelli, we hear about all the money flowing into private credit, so potential spread compression, more competition, banks also moving back into the space. Churchill plays in that core middle market, so can you briefly talk to us about that and what that looks like?
Sure. So if we think about banks returning into the market, and really banks play a role predominantly in the public markets. They're the arrangers for broadly syndicated transactions. They issue those transactions to really distribute. So they're going to syndicate the entirety of that loan position. So banks coming back into the market is more of an issue for upper middle market managers. So if you're looking to seek financing as a private equity sponsor, you have the ability to go to the public markets and get a bank solution, or the private markets and align with an upper middle market asset manager. And that's where that kind of dynamic tension is occurring between the upper middle market and the broadly syndicated market. We being focused in the core middle market, these borrowers are generating on average 50 million of EBITDA. There's not a public debt solution for a borrower of that size. So we are much more insulated from that competitive dynamic that the banks might bring to market. Banks, their role in the core middle market where we play tend to be more from a liability provider. So they're issuing the debt for our levered funds. So they still have a role in our market, but it's not from a competitive perspective.
Yeah. Kelli, here in Australia, we've been seeing a lot of press about valuations. Talk to us about what that looks like in your world.
Yeah, so there's a big focus on valuations, particularly in US private credit market. We want the asset valuations to be transparent to our investors. So those valuations are included in quarterly filings. You're able to see from the difference between the cost basis for the original asset and where that asset is valued. So those are refreshed on a quarterly basis. Depending on the asset manager, most of that is going to be provided by third-party valuation firms, not a task that's performed necessarily internally. So a lot of focus on that, and investors like to see that transparency.
Yeah, and that's all about avoiding a conflict of interest, I assume, having an independent third party do the valuation.
Exactly,
yeah.
That's right.
Kelli, deal flow was expected to rebound. Have you seen an uptick?
Yeah, if we think about 2025 and really what the deal environment has looked like, I divide it into three categories. So we had the beginning of the year. I would say most of us were cautiously optimistic for a rebound in LBO activity. And for the most part, first quarter, we did see an uptick in activity. Deal flow was pretty consistent. Sponsors were getting some footing and some nice transactions coming to market. Post April 2nd, with the tariff announcements, that tended to put a little bit of a pause on new deal activity for a pretty short period of time. Deals that had any sort of tariff impact to them were sidelined, and the deals that continued to come to market would be deals that didn't have a tariff impact, a very strong credit story, an industry sector that's not going to be subject to cyclicality. So businesses that are very high performing tend to be the ones coming to market now as sponsors are looking to exit those positions. And so we've had a pretty robust resumption of deal activity as we head into the late second quarter and now into the third quarter. So expectations are we should have a pretty solid second half of the year.
Kelli, talk to me about Churchill's access to private equity sponsor-backed deals. It's often cited as a key advantage. How is that pivotal in your approach?
It's absolutely a key advantage. So the way it works in the US core middle market is the private equity firm will invite lenders to participate in the transaction. So if you don't have the deep-seated relationships and that trust established with the private equity community, you're likely not going to be shown those deal opportunities. So Churchill is very unique in the way we source our transactions. All of our transaction opportunities come directly from our private equity relationships, and we actually have the ability to be an LP in over 325 private equity funds today. So those GP relationships in turn will show us deal flow. So it's a very unique competitive advantage that we can enjoy in the market, that we have those LP investments, in turn that will drive our deal flow from our GP partners.
Kelli, just to follow up there, if I may, just so that the viewers understand, how long does it take to build some of those relationships? So they don't happen overnight, right?
They sure don't. I mean, but to invest in a private equity fund as a limited partner, that's a decision that takes a lot of due diligence. You're going to diligence the track record of the sponsor, the track record of the funds themselves, their portfolio investments. And once you invest as a limited partner and you're able to source that deal flow from the sponsor, you then build that second leg of that relationship where you're now a lender to that private equity sponsor for their underlying portfolio companies, and you transact multiple times with that sponsor. And throughout that life of that loan, you're going to have various amendments, incrementals you're providing. So all of that fact pattern and relationship building is absolutely critical in this space. We contrast the private credit market as a relationship-driven market and the liquid market as more as a transactional-based market. So it's a stark difference.
Kelli, rates might be higher for longer. That's sort of the narrative that's being bandied around. What will that mean for yields and private credit?
So the base rate of our underlying loans is going to be SOFR, and SOFR has been consistently quite high for some time. And then we add a spread on top of that base rate. And then you have a slight discount on the loans that you're underwriting as well. So those three components constitute the yield on the underlying asset. And if we look at where yields are in the U.S. middle market for first lien senior secured loans, they're in that 9 to 10% range, which is quite attractive and far in excess of the historical average of first lien senior secured loans, which have been in the 6.5 to 7% range over a longer period of time. So despite the movement in the market, we're still seeing from historical levels a nice premium for the asset class.
Yeah. Kelli, talk to me about floating rate structures. Are they still dominant in your loan portfolios, or borrowers, are they shifting preference, and does it matter?
So from a first lien senior secured perspective, those are always going to be floating rate investments in our market. Again, you're going to have that base rate of SOFR and then the spread on top of it. When you think about a fixed rate instrument in the private credit market, that's generally going to be a junior capital investment, and those fixed rates will vary based on the market environment, but they're going to be low double-digit rates on those investments.
Yeah. Kelli, we mentioned it earlier, competition in the space. There seems to be more money flowing in and the same or not too many more deals. How do you maintain underwriting discipline? What does that look like?
It's absolutely critical.
Yeah.
It's easy to get caught up in lending to a specific market environment that exists at that time, but it's important to not get caught up in that and realize that you're underwriting these investments for a longer term duration, and your investors expect you to do that. So despite whatever market environment from a macroeconomic perspective exists or an interest rate perspective exists, you should be underwriting those investments to make sure that you're structuring those investments to be sustainable for varying economic and interest rate cycles. So Churchill is very good at maintaining that discipline. It's what really has made us as successful as we have been in the U.S. private credit space, and we continue to do that. So if we think about the competitive nature and perhaps competitive attributes to the market making some assets a little more risky as far from a structure perspective, that's not something that we're going to be susceptible to. So we're going to maintain our discipline.
Kelli, it's one thing to find the right investments and then, of course, make those investments. But the other side of it, of course, is the exits. What do exits look like at the moment? What do investors need to be aware of?
Yeah, that's the big question in the market, right? So when we enter a loan in the U.S. private credit space, the legal maturity of that loan is going to be somewhere between 6 and 7 years. But the expected exit is generally going to be 3 to 4 years in a normal market environment. And that exit will be prompted by that sponsor selling the business to another sponsor and that deal being repaid. Now in the environment, because sponsors are holding on to businesses longer, that 3 to 4 year life cycle is getting pushed out considerably longer. So there are times when the deal will actually meet its ultimate maturity, 6 to 7 years, and the sponsor's looking to hold on to that business even longer. So what we've seen introduced into the market is this concept of continuation vehicles, where the sponsor will actually sell the ownership of that asset into a continuation vehicle. We as the lender have the ability to continue to finance that borrower in the new equity structure in the continuation vehicle, and that's actually pretty nice from a portfolio management perspective because you're having less repayment in your funds. You're holding those high quality assets for longer, which isn't necessarily a bad thing. So those exits, again, that 3 to 4 year time span has extended considerably. That's all going to be tied up on if the market comes back in more full steam in the second half of the year. We'll see more of those natural exit opportunities as sponsors start to transact with each other, and we'll see where that shakes out.
Just one follow-up, if I may. The reason why the businesses are being held on to longer, is it because their businesses are performing well and there's a natural inclination to hold on it and extract more value, or is there not a buyer on the other end at this point in time?
It's an excellent question. There's certainly a buyer on the other side. The question is whether that buyer is willing to pay the valuation that the selling sponsor thinks that business should fetch. So for example, a sponsor that paid 15 times for a business 5 years ago would like to see the exit transaction multiple continue to be 15 times. So with cost of capital where it is, and macroeconomic headwinds existing or not existing, the buying sponsor needs to be convinced that that 15 times multiple is appropriate. So that's the negotiation that'll take place at that point.
Yeah. Kelli, fascinating stuff. Thank you so much for sitting down with Livewire today and taking us through that.
My pleasure. Thanks for having me.
If you enjoyed that interview as much as I did, make sure to give it a like, and don't forget to follow our YouTube channel. We're adding lots of great content every single week.